All right. I believe we're live. Welcome in. Happy Saturday. I hope you are making today the best day of your life. What's up in the chat? I see what a sale. Yeah, man. I love that. It's uh it's me today. It's just me on this channel. But obviously Ben and I will be live again on Tuesday on Memes and Markets. And the nuclear boy scout said, I wonder if Jake Claver's theory might actually play out. We'll definitely be chatting about some of that today. What's up, everybody? Say what's up in the chat if you're here with us. So, today we're going to very quickly go over some of an update of what's happening with the situation in Iran. We're going to talk about what this means for markets. We're going to talk about the importance of oil and the impact that it's going to have on global markets. And we're going to take a look at how markets have been reacting to everything so far. And of course, we'll talk about what to do about it, right? And how to position and just think about at least what exactly is going to come next and how to position around all of that. So, on top of that, I do have an announcement of a partnership that I am beginning that I'm super excited to bring to your attention as well. So, welcome in. Let's go ahead and just start off with what's going on in the markets because I think that's going to be the big thing. Excuse me, I didn't mean that. I meant in Iran. Let's start off with what's been happening in Iran. Another thing that did just happen, by the way, is the White House yesterday dropped Trump's cyber strategy. Okay, so that was something that came out of nowhere. I hadn't seen that until today. But let's start off with the most recent thing that's happened in Iran that's going to potentially define what's coming next. So the big thing here is there's a lot of messaging coming out of this entire conflict that is pointing toward the idea that the United States is not really as successful as people are being told. And there's a lot of damage that the US has been taking regarding some of their infrastructure in terms of like radars that they've built up in the region. But we're going to talk a little bit more about all of that. But the big thing here as well is we'll watch some clips from some people who are really intelligent about all of this. But the big problem here is that there's a large amount of really important resources that are flowing through the Strait of Hormuz. It's not just oil and liquefied natural gas. So Iran has closed off the Strait of Hormuz. Uh, 20% of the world's oil is flowing through there. About 20% of the world's liquefied natural gas is flowing through there. But so does fertilizer. And for them coming in, they're importing over there the Gulf countries' food. Okay. And one big move that just happened that is going to be problematic around how this all continues to escalate is that it seems that someone has struck a freshwater desalination plant on an island in Iran. So the thing here that's going on is that Iran and the other Gulf Coast countries on the other side of the Strait of Hormuz. Let me just go ahead and pull up the Strait of Hormuz so you guys can see. You got Iran up here on the north, right? And then you've got all of these Gulf Coast countries over here on the west/south. And almost all of them are completely desertous countries, right? And because of that, there's not a lot of water. And all of the water is coming from the sea here, which requires them to use that water and desalinate or take the salt out of that water in order for it to be actually usable within these countries. And what's just happened here is that the US just struck a freshwater desalination plant um, on Keshem Island. I'm not sure how to pronounce that. And the thing is that Iran can also do that back, right? They can do that to the other countries, right? They can do that to all of the Gulf Coast countries. And that's just something that, first off, is also not necessarily legal to be taking these actions because this is not an attack on the military, right? This is an attack on the people at this point. And it also just escalates the war in a way that is not ideal. So let's actually go ahead and listen to um, a couple of things from Professor Zhang as we continue to get into this. One more piece. So Trump, I think it was earlier today, came out and said that Iran has surrendered to the Middle East neighbors, right? So they're saying, hey, we're not going to attack our Gulf Coast country members, our people across the Gulf. Okay, we're going to try to keep it all cool over here at least. But a lot of reports have said, well, as that was happening, there were strikes going on. There seems to be um, a disarray between the actual official Iranian government and the RRGC. And so things are just starting to heat up a lot. But let's listen to Professor Zhang talk a little bit more about the Strait of Hormuz. Oh, well, that's not it. And the importance that it has in this conflict really quickly here.
We'll tell you things to keep in mind about this map. This is what we call this area, okay? Really small, but it's 33 kilometers wide, okay? People can swim across it. It's really, really narrow, okay? This small area, guys, it's called the Strait of Hormuz, all right? And
can you guys hear this? Let me know if you can hear that.
It's important because it's really the center of the world. This one area is the nexus, the pivot of the world. Let me explain why. First of all, from the GCC, you have 20% of all the world's oil flowing through this narrow strait. Where does it go, guys? It goes to Asia, India, Pakistan, South Korea, China, Japan. India depends on 60% of its oil from this area. China depends on 40%. Japan, 75%. Prime Minister Takaichi of Japan has said that, listen, if the Strait of Hormuz closes, we will run out of oil in about 8-9 months. The entire Japanese economy would collapse in 8-9 months if the Strait of Hormuz were to close. And guess what? The Iranians have closed the Strait of Hormuz. Okay? So we can expect that the entire global economy will suffer greatly over the next few months. All right, so that's point number one. Point number two is, okay, so the GCC sends oil across the Strait of Hormuz, and what do they get back in return? Food, guys. All right, so people don't appreciate the GCC, but it is really the linchpin of the American empire. Because what is the American empire? The American empire is the petrodollar. All right? The idea of the petrodollar is this. The US dollar is worth nothing. It's only valuable if people want it. But the GCC says that if you want oil from us, you have to pay us in US dollars. Okay? Then that is the basis of the value of the US dollar. So, if the GCC collapses, the American economy and the American empire both collapse at the same time. The problem, though, is that GCC is an artificial construct of empire. It does not exist naturally. Why? Because there's no food, there's no oil, no water. Okay, guys? No food, no water. So these cities are able to grow in the millions because of all these petrodollars flowing in. If you close off the Strait of Hormuz, there's no food coming in, right? They're all going to starve. How much food does the GCC get from overseas? 80%. 80% of all the food it consumes comes from overseas, that it imports. It doesn't grow by itself, it imports. All right? So the Strait of Hormuz is really key. And again, the Iranians will close it in order to strangle the global economy and therefore bankrupt the American empire. All right. Second thing you will notice is these mountains. These mountains is what we call Iran. All right, this is Iran. This is GCC. Okay, this is not a fair matchup, right? Because these are mountains. And what can you do in mountains? Well, you can hide rocket bases. You can hide drone bases. You can hide missiles. And that's the entire Iranian offensive strategy. All right. From here, they can hide missiles and drones from which to attack the GCC. And what are they attacking? They're attacking three things, right? They're attacking American military bases. American military bases. That's number one. Okay? Is it possible for the Americans to defend against these attacks? The answer is no. It's not. It's the silliest thing in the world. You have all these bases in the Middle East, but you cannot defend them against the Iranians. That's kind of strange. Okay, but that's number one. Number two is oil and energy. How hard is it to blow up an oil field with a drone? Not hard at all. Can you defend these oil fields? No, you cannot. All right? Number three, and this is most important, is water. Okay? You guys don't know this, but the GCC has little access to fresh water. So the only way that it can produce water is what we call desalination plants, okay? These factories that take salt water and then through electrochemical process turn it into fresh water for the population to use. 60% of the water supply in the GCC comes from desalination plants, okay? 60%. Is it hard to blow up a desalination plant using a drone? The answer is, it's very easy. You understand? Okay? So you have this absurd situation where Iran is a mountain fortress, where it can hide its offensive capacity, and the GCC, it's just this desert, this flat desert, and it is exposed to attack, and there's nothing it can do about it, okay?
So now, one of the things that he does not mention here that's also a massive, massive problem with what's coming through the Strait of Hormuz is fertilizer. So this is another massive issue that is just bubbling up around this entire crisis. So this article here points at the real threat from Strait of Hormuz closure isn't an oil shortage, it's a global food crisis. So a couple of things, right? So the first thing that they point out here is that the global food system has a far thinner buffer than energy markets, right? The thing about energy markets is there's different types of energy, right? There's different ways to get energy. You've got diversified energy sources within each country. You also have stockpiles of things like oil. We'll talk about the Strategic Petroleum Reserve in the United States. But the big thing here is that we're talking about a very, very large percentage of fertilizer, which is needed for just about all of agriculture, right? And it's a specific fertilizer called urea, is about a third of it is passing through the Strait of Hormuz alone. So we've seen this show up in the pricing of this fertilizer in the past few days, where it's gone from being around 442 per whatever that unit is up to 583. So about a 25%-ish gain in the price of this fertilizer in just a few days right into this conflict. So this is another thing. People are thinking about, oh, well, this is just something in the Middle East. No big deal. Who cares? This is going to have massive impacts across all of the economy, all over the place, and potentially beyond just the economy and into real world impacts on how this stuff will really have an impact on everyone's life. So just wanted to point that out because I didn't see him talking about that in particular in this clip of Professor Chang here. But that's another really important piece of what's going on. So a quick update on some of the things that we've seen happen today. We also had Kuwait confirm that they've cut oil production. So that leaves, I believe, two countries now that have stopped their oil production. I believe it's Kuwait and one other one. It may have been Bahrain. And the reason for this is because of the fact that you have a bunch of oil just piling up. There's no more capacity for the storage of the oil in the region. Okay. Because the ships aren't able to pass through the Strait of Hormuz. So now you've got all these ships that are just sitting there with all this oil, all of these refineries, or excuse me, these production facilities that are producing, pumping oil. They're out of space to put it. So they have to halt production. Now, you know, the spillover effects of this, it could be pretty massive. And the first thing that we want to talk about here is obviously the impact that this is going to have on the oil market. So we're going to listen to a quick excerpt from a David Lynn interview with a guy named Josh Young, where he talks about what he thinks this could lead to for the price of oil. And
What is
so
it?
far, we've already seen an impact. Let's just quickly touch on that first. So right now, WTI, West Texas Intermediate oil, is sitting at $89. If we look at Brent crude oil, it's sitting at $90. And this is the largest weekly gain that we've seen for oil since 1982. Okay. And that's percentage wise, right? So it's just a big spike here in the price of oil. And this is very likely to continue and to also eventually spill over into other parts of the market. So let's quickly listen to Josh Young on this topic.
In global supply chains as to why the Strait of Hormuz closing would necessitate $200 a barrel. And obviously that means much, much higher gas prices at the pump for all of us. So if you look back at COVID, for example, actually oil prices collapsed, and to a certain extent, some futures went negative for a very short amount of time. Now, obviously the conditions are completely different, but for the layman, the result is the same, which is a supply chain disruption. And so what is fundamentally different about the Strait of Hormuz closing and supply chains being disrupted from oil tankers being stalled in 2020? Both are supply chain disruptions, but what is the difference?
Yeah, so the big thing for oil during COVID wasn't the supply chain disruption. It was that governments forced people to stay at home for extended periods of time, which killed oil demand and temporarily pushed oil demand down by close to, I think at its peak, close to 20 million barrels a day, which is amazing that actually you had most oil consumption sort of still continuing, even with people essentially locked in their homes by government edicts in Canada, US, various other Western countries, China intermittently. So this is almost sort of a mirror of that, where it's not like there's a 20% demand boost, but there's a 20% supply cut, essentially, where about 20% of oil exports come out from the Strait of Hormuz, and then a meaningful amount of liquefied natural gas exports come out from there, as well as various other chemicals and chemical precursors and so on. So it's a similar proportionate effect. And so in the same way as you saw oil go negative from that sort of demand shock, proportionally similar, I think you could see prices go similar the other direction from this supply shock.
Can the U.S. draw on a strategic petroleum reserve to alleviate some short-term pressure on the oil price? This is from the EIA, and as of December 2025, it's reported that the SPR has over 400,000 barrels in reserve. Is that enough, do you think?
Yeah, it's
So really quickly, let's touch on this concept of the Strategic Petroleum Reserve. So the United States has what's called the Strategic Petroleum Reserve, or the SPR. And this is the government's stockpile of crude oil. And so this was something that was created so that the United States could have a stockpile of oil in events like what is occurring here, or for any sort of an event that would put a supply constraint on how much oil the United States has access to. So any sort of a major supply disruption is what this is created for. It could be a war, it could be an embargo, or even a natural disaster, right, that they put this in place for. And this was created in 1973 after the oil embargo, when the Middle Eastern oil producers cut exports to the United States and other Western countries. And at that time, it created major gas shortages. There were price spikes and long gas lines that were across the United States. So in response, the U.S. passed the Energy Policy and Conservation Act in 1975, actually is when it fully came into effect, which created the Strategic Petroleum Reserve. And so the idea here is if anyone wants to cut the U.S. off from oil, well, the U.S. will have its own supply that it can pull from. But the truth is that this has a limited amount of impact that it's really going to have. You've got these caves that are in Texas and Louisiana that are the main sites where there's these giant underground caverns where they're storing this oil. And at full capacity, the Strategic Petroleum Reserve can hold somewhere around 714 million barrels of crude oil. But for some perspective on that, the US is consuming somewhere around 20 million barrels per day. So that means that the SPR could cover about 35 days of total US demand for oil. But it's also worth considering that the US is not going to just release all of this at once. They slowly will make the oil that's in the Strategic Petroleum Reserve available. And so there's two main ways that it will ever get released. And this is through one being an emergency release. If there's some major disruption to supply, like a war in the Middle East or some hurricane that damaged refineries. Or the second scenario is when there's just a market stabilization effect that is needed. So sometimes the government will release oil simply to reduce price spikes from whatever reason that might happen. So, for instance, in 2022, the Biden administration actually released 180 million barrels to reduce gas prices after the Russia-Ukraine war disrupted overall supply. So I'm describing this because this is going to be a big part of the discussion here is this going to be a reason to start to use the Strategic Petroleum Reserve? And if so, what impact is that actually going to have? A couple of things that's important to understand is that the SPR stores crude oil and not gasoline, right? Or the end product that you get from oil. So this helps refineries get access to oil that they can then turn into fuel, but it doesn't, you don't just have just gas, right, sitting in the Strategic Petroleum Reserve. That's not exactly how it all works. So in this clip here with David Lynn, he's asking him about, hey, what about us using the Strategic Petroleum Reserve? Is that an option that can kind of come into play here? And I want to quickly show you what Lynn Alden was saying about this, as well as, well, Josh Young. Okay, so he said, whoops. This is who we're actually listening to. I didn't realize he was also in the tweet. He said, whoops, the weekly U.S. ending stocks of crude oil in the SPR. And if you pay attention there, like I was saying in 2022, that number started to decline. The amount of oil in the Strategic Petroleum Reserve started to decline as the U.S. was using this oil to prevent having to have higher oil prices at the time due to the Russia-Ukraine conflict. And at this point, we can see that it never really fully got refilled up to those levels that it was at prior. Now, so Lynn Alden said, well, at least we proactively refilled the Strategic Petroleum Reserve before all of this. Oh, wait, that didn't necessarily happen. So let's hear Josh Brown fully talk about that. I'll rewind just a little bit so that he can set up the question.
Some draw on a strategic
Or the other direction from this supply shock.
Can the U.S. draw on a Strategic Petroleum Reserve to alleviate some short-term pressure on the oil price? This is from the EIA, and as of December 2025, it's reported that the SPR has over 400,000 barrels in reserve. Is that enough, do you think?
Yeah, it's 400 million. Yeah, so the problem is you can only draw
400 million.
You can only draw, I think it's something like 1 million, maybe 2 million barrels a day out of that, but it's quite difficult to draw a lot out. Frankly, we should have been drawing on this as soon as bombs dropped. If we started drawing on it ahead of time, that would have been we sent aircraft carriers. I guess that wasn't enough of a signal, but if we had pulled on this before invading, then it would have been a signal. I think this not being drawn on yet is a sign, or at least not being announced to have been drawn on, is a sign of sort of unpreparedness or unseriousness by the Trump administration regarding this operation in Iran. We should certainly be drawing on it. And it's not because the U.S. is undersupplied. The U.S. is actually fine. We're a net exporter of oil. All of this is actually good. The shock is not good, but higher oil prices are net beneficial for, just like for Saudi Arabia, higher oil prices are good for their economy. Higher oil prices, the U.S. is also a net exporter, and oil is very capital intensive and very labor intensive. Higher prices over time are good. But, this is a shock, and this is what the SPR, it was literally built for a disruption in the Strait of Hormuz. If you look at when it started, it was around the Iranian Revolution in 1979 because of the physical disruption. It's literally for this. And it's very sad that it was drawn on for, to suppress prices ahead of elections and for funding for various things. Like, our politicians literally robbed
and it's
our
not being
future.
drawn
They
right
robbed.
Now.
They robbed us of our ability to not have this shock because of their budget constraints and ridiculous partisan politics. So we were robbed. It should be released now. And it was built for this, and it's at half size because Biden drew it down in 2022. It was not necessary then. And it was certainly not necessary to bleed it off over the last couple of decades in order to, have slightly lower budget deficits.
So, one thing that I do want to also kind of point out here is that Josh here, he points out that the United States is a net exporter of oil. Now, while that is fundamentally the case, and the point that I believe he's making is that higher oil prices does not necessarily be a bad thing for the United States in terms of the companies that are selling oil and the profits that they're going to make. But there's a nuance here when it comes to thinking about the actual use of the oil in the United States that has to be considered, which is that a lot of the oil that the United States actually drills out of the ground is actually exported to somewhere else for it to be refined and turned into actual fuel. Now, the reason for this being, well, let me keep going. The U.S. imports oil as well, right? And it imports a different kind of oil. Okay, we talked about this when we were talking about what's going on in Venezuela, which in Venezuela, they have a heavier type of crude oil. And the refineries that are in the United States, from what I understand, are built to refine that heavier crude oil and not necessarily the lighter crude oil that we produce in the U.S. So the U.S. is exporting the light crude oil somewhere else for it to be refined at refineries that are made for that, and is importing oil that's a heavier type of crude oil. And so, although the United States has a strategic reserve, although it has this net export position of oil, right? There's this like excess amount of oil. It doesn't necessarily mean that there's an excess amount of oil that the United States can actually use, right? So feel free to correct me on any of that if you guys have some updates on how that works. But that is my understanding of the situation. So a few things to touch on regarding this whole idea of having these strategic reserves and what that has meant. So as was kind of being mentioned here, it would have made sense to really stockpile this oil, right, going into a war. It's basically everyone's talking about, well, why wouldn't we have at least increased the amount of the strategic petroleum reserve before making a move like this? How are you just going to do this without preparing for it? And on the other hand, on the other side of the ocean, we saw that China, for instance, was actually doing that. So in February, Zero Hedge actually pointed out that China's unprecedented oil stockpiling sparks questions if Beijing is preparing for war. This was back in the middle of February. And Zero Hedge came out yesterday and said, yes, it was. And two, China has 1.2 billion, as much as 1.5 million barrels, 1.5 billion barrels in its strategic petroleum reserve. So one thing to consider there, right? The big question here is how involved is China going to get in this war? Because you've got Russia, you've got China, and depending upon whether or not they decide to get involved with this, it's going to really change the dynamics of what the United States can actually do, period, right? If you get China involved in the war, then things are going to get a lot more serious and very quickly, and all of this spirals into a much larger conflict. Peter Zeihan, one of the most respected geopolitical analysts on the YouTube space at the minimum, he came out and actually gave us a little bit of knowledge around what's happening regarding China and the Strait of Hormuz at the moment as well, because China does have a relationship with Iran, a very important relationship with Iran. And it turns out that there's something going on here right now that might not have been reported by the mainstream outlets. So let's hear Peter talk about what he's seeing between China and Iran at the moment and how the U.S. may or may not be trying to get in the middle of this conflict. So let's hear him.
Iran has been using to target the and we're seeing a few things settle. It appears that the United States really has gotten a bit of a grip on the ballistic missile launchers that Iran has been using to target the Arab states on the western side of the Gulf. CENTCOM says that day 7 compared to day 1, that the number of missiles that Iran has been able to fire are down by 86%. That might be a little optimistic, but it's definitely over 3/4. There's really hard to get day-on-day reporting because it's such a broad area. Anyway, it's made a big impact. We're talking about single-digit to low double digits of missiles being launched at any particular location, and so far, interceptor stocks are holding, if barely. In the longer term, this is still Iran's fight, at least this specific vector, largely not because of missiles, but because of drones. Missile launchers require a truck that can take 50 tons or a rail system. A drone just requires a rack in the back of the truck to be spot welded together in a few hours. So it really doesn't matter if the Americans take out the drone launchers, because those will just be back in play very, very soon. The question for the drones isn't the launchers. The question for the drones is the manufacturing process. Now, the United States has taken out several spots where this was centralized, but some of these things are made out of plywood and styrofoam, literally. So you can make them in a garage, and they have already had a significant dispersal pre-war of their manufacturing capacity. But the bigger problem is going to be China. While the Strait of Hormuz is closed to any normal traffic, the Chinese use a lot of shadow fleet vessels, and those are apparently still going through at night. And the United States has not set up any sort of blockade of Iran's ports. They've sunk the Navy, but they've not destroyed the port infrastructure or gone after the cargo ships that are coming in. So I've seen reports overnight that the Chinese are sending cargo vessels into the Persian Gulf. And keep in mind that the majority of the components that end up in a Shahed drone originate in China, and then they have some manufacturing add-on and assembly in Iran. So we're in this really weird situation at the moment where the US Navy has its greatest concentration of power in decades in the Persian Gulf, and the Chinese are literally shipping war material into Iran to make drones to attack US assets. It does not seem to me that this is a viable option over the midterm, but at the moment the Trump administration has decided to allow it, or just ignore it, despite the damage it's causing and how it's eroding the few number of interceptors that are left. When and if the Trump administration does decide to either confront China with this or just stop the vessels from docking, then we're in a very different situation. The Chinese get the majority of their energy from the Persian Gulf. They are the country on the planet that is most dependent on flows in absolute terms from the Persian Gulf.
So basically here, there are components that Iran needs to be able to continue to create the drones that they're using in this conflict. And China is where they get those components, and China is still shipping those components through into Iran. And so, quick breakdown here, because I also saw this put together. These drones that Iran has been putting together are being produced at somewhere around like $20,000 a pop, which in terms of being able to carry an explosive load that you can deploy to certain parts of the world, maybe not over the ocean or anything, at $20,000 a pop is pretty cheap, right? When we're talking about military budgets of billions of dollars. So let me show you a little bit of something here too. I thought this was fascinating. This was a news report that was put together around the US actually reverse engineering these types of drones. So let me play this clip real quick.
The U.S. military is using a brand new weapons system in this conflict. Let me bring in a life-size model so we can have a look. This is the Lucas Attack Drone. It stands for Low Cost Unmanned Combat Attack System. It's about 10 feet long, about 8-foot wingspan. It's powered by a propeller, so it doesn't give off a big heat signature that can be tracked easily. Carries about 40 pounds of explosives. And interestingly, this was modeled after, cloned from, an Iranian drone, the Shahed 136 kamikaze drone. The Shahed is a real favorite with the Iranians, and when one was captured by U.S. forces, they took it to engineers and said, make us a copy of this, and even better. Now, when the Iranians are launching their drones to attack outward, the U.S. is turning a very similar device back upon them and turning this small weapon into a big player in this battle.
Fascinating there. Some people were leaving comments saying, really? Like the U.S. is having to copy the strategies of, this smaller country that's not as powerful, this and that and whatever. I want to give a quick shout out to X Account 01 for the super chat. I really appreciate your super chat there. Very, very much appreciated. So a couple of things that people have been pointing out around, the U.S. doesn't rely on the Gulf for oil, and therefore this is all way less important than it may seem. The Kobesi letter puts out a quick piece here talking about the U.S. dependence on Persian Gulf oil has never been lower, has almost never been lower. U.S. imports of crude oil from the Persian Gulf countries are down to around 500,000 barrels per day, near the lowest on record. Imports from Saudi Arabia, Kuwait, UAE, Bahrain, Qatar have declined about 2.5 million barrels per day since the peak in 2003. Just 9 years ago, the U.S. was receiving 2 million barrels per day from the region. The current level of imports is now only above the 2020 pandemic shock and the 1980s low. So meanwhile, U.S. crude oil production stands at 13 million barrels a day, near an all-time high. So the U.S. is more energy independent than ever. So once again, when we see this narrative, because this is going to continue to come up, oh, the U.S. is not getting their oil from the region, we really have to be careful about what kind of oil it is that we're talking about. And in fact, Shanaka Pereira put together a really good piece regarding this and thinking about not only the oil that we're producing in the United States, but also the oil that's being produced in Iran as well, because there is a really big difference in how this goes down. So he points out that crude oil is not a uniform commodity, it's a spectrum of hydrocarbons with different molecular weights, and the composition of a given crude determines how easily it converts into products that refineries actually want to sell, right? So you've got this crude oil, but you've always got to turn that into something that you can sell. And as we talked about a little bit earlier, there's different types of crude oil. So the Iranian light crude oil has what he's defined here as 33 to 36 degrees API gravity. So the API gravity, the lower the API gravity means the heavier the crude, which requires more energy, more processing steps, more capital equipment, and produces a higher share of lower value residuals. So the heavier the crude, the more expensive it is to turn that into real diesel or fuel that we can use. So Iranian crude, and he talks about Venezuelan. Okay, Venezuelan has a very low API gravity, which means it's a heavy crude, whereas the Iranian one is double that in terms of API gravity, and therefore lighter. And then West Texas Intermediate is super light crude, right, compared to the rest of these. And so the point he's making is that Iranian oil fits where both U.S. shale and Venezuelan heavy do not. It is the liquid that flows through the middle of the global refining system without requiring either the coking infrastructure for heavy crudes or the blending operations for ultra-light shale. And that molecular fit is why it commands a persistent premium above comparable grades. It is why Indian refineries maintained Iranian crude purchases through every round of sanctions and negotiated the logistics to keep that flow moving. It's why Dubai shadow banking and trading networks in the UAE are now considering dismantling. Okay, hold on. Okay, that's why it existed in the first place, he was saying, because they're considering dismantling this whole trade network. So the Strait of Hormuz doesn't just carry oil. It carries a specific category of oil that the global refining system was built to process most efficiently. Closing it does not just reduce supply, it removes a grade of crude that the system runs best on and forces every refinery in the world to run less efficiently on whatever it can find as a substitute. So these are some of the major things that I wanted to kind of just talk about that I've kind of been gathering as things go on. But I think now is also a good time to actually look at what's happening in the markets. So over the past, let's see here, a couple of months, when we go back to the beginning of the year, this is the Dow Jones Index right here. Dow Jones Industrial. Most of the equities markets in the United States have just been moving sideways, completely moving sideways. Throughout all of the AI stuff going on, we really saw dispersion where we saw some stocks go down and then others go up on that kind of news to keep things flat, right? If you've got an index, an average, and some things are going down, but some things are going up, then the thing can stay flat, right? And so, but just this past week, we did see a dip in the actual price of some of these indices. So the S&P 500, not as dramatic as the Dow Jones Industrial. Same thing for the NASDAQ, nowhere near as intense as the drop that we've seen in the Dow Jones Industrial Average. But we are starting to see the markets finally slide. When you see the market chop around sideways like that for such an extended period of time, you can pretty much expect that what comes next is a decline, right? Especially at the beginning of the year. It's almost textbooks from what we saw last year. If we scroll back and we look back to what happened last year, let's see, where were we? Yeah, so January went sideways, went sideways, went sideways, and then it dipped at the DeepSeek announcement. And then for the rest of that time, we had all the stuff with the tariff announcements and all of that continued to tank the markets even further lower. Now, we're starting to get an actual retracement in risk assets, a risk off sort of a sentiment coming in through this war. At first, they weren't even really reacting to this. The markets, the indices were not really reacting at all. And just this week, at the end of the week, we started to finally see a slide. Now, my personal take on what's happening here is that this is probably going to be something that can continue. The fact that the markets haven't responded at all to what's happening to me says that there's a real opportunity for a surprise to the downside. I talked about that in the video today, right? Why would we chop sideways at the beginning of a war? That doesn't make any sense. That means that if anything really bad happens, then the market is going to slide drastically. It's almost the opposite of what we've seen multiple times throughout the past couple of years, where if anything, just the bad news alone has led to a massive price decline. And when just the news alone leads to a massive price decline, then that means that there's just maximum uncertainty. And when there's maximum uncertainty, then that can provide the maximum opportunity because of the fact that the market has slid off of just speculation on the fact that we don't know what's going to come next. Right. Now, on the other hand, what we're seeing right now is the market saying, well, I don't care, right, about this that's going on. This should probably not be too big of a deal. Well, in that scenario, I'm going to be a lot more on edge about the fact that anything bad that does happen, any bad news announcement that we do get is probably going to slide a little bit lower. So that's what I said in the video today, kind of thinking about, hey, I think that might be the one thing to keep an eye on is any news that we get about, the war not being as short as we're being told it's going to be. It could be literally just that alone, or some, escalation of the conflict, right? Then you're going to see a decline in this index and these indices in general. Now, on the other hand, we have oil. Okay, this is obviously the other big thing to keep an eye on right here. Oil is pushing up very drastically, very quickly. This is something that unless we get a drastic change in the state of what's going on, it's going to continue. Okay. And it's not going to be something that it happens really slow. Oil almost moves like the VIX, the volatility index, where it just kind of like spikes, right? And then after that, it'll slowly kind of make its way back down and cool back off. But we're just at the very beginning of what can happen here. If we look out through history, if we look back to the higher prices of oil, you've got June 2008, you had oil at $240. Now, we have to keep in mind here that this price is not also naturally adjusted for inflation at all. So that $240 price that we saw in 2008 was not really $240, right? We'd have to adjust for inflation. That number would be a lot higher, right? It might be like $300, $400 per barrel of oil at the time. So my guy said quarterly theory. Where is that at? Oh, okay, it's on the chart. So just keeping all of this in mind at the moment, oil spiking, that's actually happening. We've talked on Memes and Markets, the live show that I do every Tuesday and Thursday. We had a guest on. A lot of controversy around this guy. I've seen some of it. His name is Jake Claver, and he has this thing called the XRP domino theory. Drop a 1 in the chat if you've ever heard of the XRP domino theory. And one of the first things that he said that would need to happen is for a spike in the price of oil to happen. Okay. Now, I'm pointing that out because we're gonna talk about crypto and what this may mean for crypto in just a minute. But for now, oil is spiking. It's probably going to continue. The reality is that there's not a really easy way to de-escalate from where we're at now. You've got a lot of claiming of this conflict with Iran going really well for the United States. This is great. This is fantastic. The U.S. is winning. But in reality, what we're going to start to see is that it's probably not going to be as easy as we're being told it would be. And so this is one of the first things that's going to show us, right, that this is getting serious. And now I want to back up a little bit too, because we had a live stream a couple weeks ago where we talked about Mark Steen. Mark Steen and how he had a theory that he put together about what was going to be the best stock of the, or not even just stock, the best move to make in the markets in this year. And the whole idea that we talked about was like shorting abundance and longing scarcity. And just to pull it back up, because this was kind of wild, he wrote this in September 2025. And he says, what if Exxon is the next NVIDIA, the game changer that nobody sees coming? And we broke this down. If you want to go back, you can go and check out that entire video where we pretty much break down this entire thing. He goes through and he talks about why Exxon is essentially the company to keep an eye on as all of this stuff continues to go on. It really just the AI race alone, right, is what he was referring to at that moment. And well, he talked about that in September 2025. The price of ExxonMobil at the time was $113. Over the past few months, we've seen the price of this stock go up to as high as $159 just over that few month period. We talked about on the channel how if we really had been watching the price of oil over the past few weeks, we saw that it was slowly starting to creep up from some of these lows that were made back here in December, right? Just slowly starting to creep up as all of the talks in Iran were going on. And then what happens? Bang. War starts, huge spike in the price of oil, and a lot of, opportunity, right, has just come out of that. Looking back at ExxonMobil again, okay, we saw back in December, prices started to rise pretty drastically. That was a little bit of a sign. Okay, we can now see in retrospect that might have been a little bit of a sign to tell us that things are heating up across the globe. Because if you pay attention here, ExxonMobil has been chopping sideways since October 2022. Okay, it hadn't really made too many crazy moves, but it started to pull off in January as well during the Venezuela situation too. So, energy in general. There's an ETF that tracks the energy, the largest energy company, some of the largest energy companies in the United States, and it's called XLE. This ETF, I'm not getting paid here. Let me tell you right now, I'm not getting paid for this one, is one of the most robust trackers of energy stocks in the United States. The cool thing about it is it also pays a dividend, as most oil companies and energy companies pay dividends. Okay. Now, obviously, at this moment, this is extended. Okay. So this isn't necessarily a time to be trying to make moves on it. But I do want you guys to be aware of looking at the different sectors in the economy when you're looking at these equities markets. Okay. And one of the ETFs that tracks a sector of the market is the XLE Energy Index. So keep an eye on this, right, as we continue to go through this conflict, for looking at potential opportunities to consider. So just wanted to show you guys that. Let's quickly look through some of the sector ETFs, see if there's anything that I want to point out. And then we'll talk about gold, and then we'll talk about crypto. So gold, I think this came up on somewhere. Oh, it came up on the podcast, Memes and Markets. We were talking about how gold immediately had this negative reaction on Tuesday. And essentially, as this war started, we saw gold kind of slide a little bit. And I said, okay, that's an interesting move for it to make at the beginning of a war. Okay. What's happening in this conflict is by far going to add a lot of demand for for gold, excuse me. And in fact, right, once again, this is another thing that might have been a signal this entire time. Okay. This might have been a signal that, hey, geopolitical conflicts are heating up. There's been a lot of people that were saying, hey, gold, when's the last time gold hit an all-time high and had a crazy run without there being a war, right? These things only usually happen during wartime. And people were saying, hey, this means something really bad is about to happen. Okay. So in retrospect, it might be kind of obvious. But now we can see that this is how we can start to have our eyes and ears aware for what's going on in the world and what these types of things may mean. Markets tend to know things before news outlets do, right? And it's because there's money on the line, right? There's direct economic and financial impact of information. And so the information can kind of flow through the markets before it hits the radio waves. Now, big thing here. Yeah, no stupid question. The question was, I got a question here. How does oil move? How does oil stocks move with oil? I think was the question. I'm not seeing it at the moment, but that's a really, really good question. Because, right, there's a lot of things to keep in mind. A company has a lot of different risks that the commodity itself does not. Right, a company has what you call market risk, right, or not market risk. Excuse me, non-systemic risks. It has individual risks. I forget what the word actually is, which means that the company, right, is one company. For instance, if something happened to the refineries that BP has or that Shell has, well, that one company is going to suffer from that. Whereas oil itself doesn't care if BP's refinery gets shut down. That just means all the other competitors can now produce more and make more money while they're shutting down and trying to figure all that out. So while a company, which is why, by the way, we talk about XLE in the ETF, because that way you don't have to choose a winner. And you can still get exposure to the entire sector. With the commodity, if there's a higher demand and higher price, everyone wins. Now, who owns the commodity? Usually what I observe is that when oil prices rise, so do the prices of the stocks that are in the oil business. A lot like what you see with the miners for gold and gold, or the miners for silver and silver. It's a different reason. It's a different model, right? Because you've got cash flows, you've got profits, you've got assets, but you usually will see that these things are going to move in correlation with one another. Key example here, Wheaton Precious Metals is a gold miner. Okay, you can see that this is what's happened over the past few years for their stock, right? And you can see how that aligns with the price of gold, okay? So just wanted to point that out. Now let's talk about the real stuff. And I've got an important, fantastic announcement for all of you as we move into talking about crypto and Bitcoin in particular. So before I tell you about the announcement, I want to be clear that this right here looks like it's going down. And when you've got war on the line, I'm going to assume that it's going to continue to go down. And once again, when we get that risk off moment, I'm going to say when. Let me back up. Let me say if we get a big risk off moment, once again, where markets get surprised to the downside, then I'm going to expect the price of this to go lower. I'm going to expect the price of Bitcoin to go lower. So for everybody who is trying to figure out, what do I do about Bitcoin? I don't know yet. Is this a real thing? Is it all over? Is this a big scam, a big Ponzi? A lot of you in here seem to not be huge fans of crypto and Bitcoin, and I totally understand. But what I'm going to go ahead and go out on the ledge and say is that when we get this next leg down for Bitcoin, it is very likely to produce what I believe will be an incredible opportunity for people who want to get exposure to this asset class. I was talking to someone last night and we were talking about, well, someone actually brought this up to me called the cone of futures, this concept called the cone of futures. And I thought this was fantastic. This is a very beautiful concept that I had never heard before. And I used it when I had now learned this when talking about crypto and Bitcoin. Because there's a lot of people that are just like, oh, I don't care about crypto. It's a huge scam. I'll never do it, whatever, blah, blah, blah. Well, there's a problem with taking something that has a high, okay, let me say it this way. There is the reality of the data of what's happened with Bitcoin, which is that it's gone from being worth pennies to being worth over $120,000 through history. Okay, so you can completely ignore that if you want. But in reality, this is real. This is what has occurred. So let's say, though, that there's a possibility that Bitcoin will be worthless one day. Okay, that may be a possibility. Let's say that there's also a possibility that Bitcoin goes up to $1 million one day. Let's just imagine that that's a possibility. This cone of probabilities helps to kind of describe what asymmetry means and why it matters when we're talking about Bitcoin and crypto. So let me go ahead and just kind of talk about what I'm looking at here. You have these different cone of possibilities. You have the possible future. You have what might be the preferred future, which for you might be, as someone who's a naysayer, you might say, "Oh, well, I don't want Bitcoin to be real. I think Bitcoin is a scam." That's your preferred future, is that Bitcoin goes to zero. Okay, cool. You have a probable future, and then you have a plausible future. Now, this is just a concept, right? Just to think about, hey, what's possible here? What are the different probabilities and possibilities, and what weight would I like to assign to them? So let's say you're a huge Bitcoin naysayer. Are you going to subscribe a 0% chance that Bitcoin reaches $1 million? Because if you're doing that, then you might be putting yourself in a compromised position, because you probably would have said there was a 0% chance that it reached $100,000 as well. You probably would have said that there was a 0% chance that it reached $10,000 as well. But the problem is that it's not a 0% chance. And if you are weighting your future on the idea that there's a 0% chance that this is the right thing, or that this is going to work, or whatever, that it goes up to $1 million, then you have now hurt yourself. Essentially, you have now damaged your opportunity. You've taken what you had was as a potential opportunity, you've reduced it to zero for no reason. The thing about Bitcoin and cryptocurrencies in general is that they are providing an asymmetric opportunity, meaning where, let's say you put $20 into the NASDAQ, let's not use 20. Let's say you put $100 into the NASDAQ, and the NASDAQ is going to rise by 10% every year. Well, at the end of 2 years, you're going to have $120, just imagine, $122, right? But with Bitcoin, let's say the average return, I believe, is somewhere around like 30%, right? So 3 times as much as you'd get from putting it in the NASDAQ. And it might be worth considering that the NASDAQ has just as much of an opportunity to go to zero as Bitcoin. Now, maybe not, right? That's not the point that I'm trying to make, but you're dealing with a risk asset, okay, where whatever you put in could go to zero, period. So when you keep that in mind and you think about the fact that you've got a 3-to-1 opportunity here to put into Bitcoin, Bitcoin has a 3 times higher return that you're going to get versus the NASDAQ. These are just examples. I'm not saying it's exactly like this. Then having a 0% allocation to Bitcoin is shooting yourself in the foot, because you would only need to allocate, say, 5 to 10% into Bitcoin. And if you get a 3-to-1 return on that, then you've still, right, giving yourself a higher chance. The probabilities, the expected value of playing that game is much higher when you put anything into Bitcoin than when it's zero. Let's say you even just put 1% of your portfolio into Bitcoin. If that went to zero, your entire portfolio is barely affected. But if Bitcoin goes to $1 million, or if it does that 30% annualized return, then you've had an asymmetric output on your portfolio, right? So let's actually do the model. You've got $1 million. 1% of $1 million is $10,000. If you put $10,000 in Bitcoin and it goes to zero, you've only lost that 10K. But if you put that 10K and you put it into Bitcoin and it goes up 3x or 30% a year, let's say 30% a year, then you made $3,000 after just 1 year. And after 5 years, you've made well more, right, than you would have from that same amount of money going into the NASDAQ. So hopefully I'm in some sort of a way describing to you the concept of asymmetry and why having 0% exposure to Bitcoin or crypto is something that is not necessarily going to benefit you in terms of actual expected value. At this point, right, if you really look at the data, Bitcoin has continued to go up over time. And when you're looking at the expected value, you're not playing the game of investing properly by just having a 0% allocation to Bitcoin. Now, hopefully some of that was helpful to someone out there in the world. Next time I'll try to actually properly prepare to describe the concept of asymmetry in your investing and how it impacts your portfolio. But with all of that said, I have an exciting announcement to make, which is that for people who are coming into the space of Bitcoin and you're trying to figure out, hey, how do I do this? I've actually just partnered up with Caleb and Brown. So Caleb and Brown is actually a personalized brokerage service in the crypto world. And by the way, guys, I have never done anything like this on this channel. I have never, ever, ever taken on any sponsors at any point in time. But I did just sign one with Caleb and Brown, and we've been talking for months because I wanted to make sure that if I was going to do this, that it was with someone that I actually trust and that I actually believe in, and that actually is providing a unique value to the market. Caleb and Brown, what they're doing is they're actually allowing you to talk to someone when it comes to making decisions about your crypto. And so in the link in the description, I'm going to further talk about this, but in the description, there's a link where you can go up and sign up for Caleb and Brown. I'll tell you why I recommend doing it. The major thing that I always tell people when they're coming into this crypto space, especially for new people, is to say, look, you want to have as many different avenues to be able to buy and sell crypto as possible. Tons of reasons behind that. There's all of these hacks that occur. There's all these things that go down. And you want to put as much, you don't want to rely on any one place, right, to have all of your crypto at. And for someone who is new to the game, Caleb and Brown is by far one of the best places to start your journey, because you're getting access to someone who is a dedicated broker who will bring you into the space, get you caught up, right? I can't take calls with everybody one-to-one, right? That's one of the things that I used to do at the very beginning of the channel. I can't do that. But these guys, when you sign up with them, they will be able to talk to you, and they will be able to give you assistance with looking at your portfolios and strategies and DCAing, right? Dollar cost averaging into the market and all of that. They have 24/7 customer support service. Now, they also have institutional grade cold storage custody. So they're partnered with one of the top of the line providers in that regard, and it's called Fireblocks. And they have one-to-one backing of your assets at all time. And by the way, Caleb and Brown has been around since 2016, which is very, very few, very, very few cryptocurrency brokerages or exchanges have been around for that long. So when you guys would like, go ahead, click the link in the description and just sign up for Caleb and Brown. You can also email my point of contact over there. His name is Jim Bazzani. And his email is in the description as well. So if you have any questions about any of how all of this works, send him an email and he'll get in touch with you and he'll take care of you. That's jim.bazzani@calebandbrown.com. So super excited about this. You guys are going to see more from them. We'll even have Jim come on every once in a while and just like talk about what's going on in the markets and what they're doing. But I just want to let you guys know that this is a part of these live streams. They are now fully being sponsored by Caleb and Brown, and you can see their logo in the corner over there as well. So that's Caleb and Brown. And welcome Caleb and Brown to the Keith D family. And yeah, if you guys ever are just looking for another place to make sure that you have some support in your digital asset journey, Caleb and Brown is a huge proponent. They're a huge, rather, servicer of XRP Army people. A lot of XRP people are going there and talking with them, and they understand the game fully. So that is at the link in the description. And I will now get back to talking about what is going on in these markets, what is going on in the world. I appreciate all of you for being here and sitting with me through that. I'm super excited for that. Thanks, guys. So here we are. Another big thing that we haven't talked about just yet today is the dollar index. Okay, so the dollar index is on the rise. And when we think about it, the dollar index and oil are very likely to move in congruence with one another. Okay, so we might actually start to see some sustained movement for oil. Okay, I clicked the link myself. It seems that it's working just fine, but I did see your your comment there. So oil and the dollar tend to move in congruence with one another. And this is a big piece of what people are talking about with this whole thing. It's like, in fact, Professor Chang, in one of these videos that I have pulled up, he really, really breaks this down super well. So I'm actually going to let him talk about that a little bit better. Because essentially, the whole petrodollar system, which we've talked about on this channel before, is built off of the fact that once the United States came off of the gold standard, thank you, CJ Jones, for the super chat. Very much appreciated. Once the United States came off the gold standard, the way that the U.S. still maintained dominance of their hegemony of their currency was by basically going out to the Gulf region and saying, hey, we will protect you guys. We'll have our naval fleet in the area. And because of that, you guys are only going to buy our oil in U.S. dollars. Okay, and so let me go ahead and bring it back to Professor Chang, really fully breaking down why what's happening right now is threatening that relationship and what this could mean for the future of the U.S. dollars. Let's get into this real quick here.
All right. So the game plan is this. You have to destroy the GCC. Why?
The GCC is the Gulf Coast countries.
Because the GCC is the linchpin of the American empire.
And let me fully break that. The Gulf Coast countries are on the west side, right? That southwestern side of the Strait of Hormuz. Okay, so we were just looking at that earlier. Okay, you got Iraq, Saudi Arabia, Kuwait, Bahrain, Qatar, the UAE, and Oman. Okay, and then you have Iran on the other side of that. So just wanted to make sure that you understood that, because otherwise it can be a little confusing.
So what the GCC does is this. It sells oil, and then for US dollars. Where does it put US dollars? It puts US dollars into the American stock market. All right, so this is investments of the UAE, okay, Saudi Arabia, and Kuwait into the US financial markets. As you can see, from 2012 up to today, it's been exploding. All right? Because the US financial markets is one of the safest places where you can put your money. The intention is this. The intention is, hey, if I cut off oil and these countries no longer have access to US dollars, they're forced to spend whatever resources they have on protecting themselves, okay? And then guess what happens? The stock market collapses. The stock market collapses. The stock market is the real growth engine of the US economy. The entire US economy collapses with it. All right? There are about maybe 7 companies in America that accounts for about a quarter of stock market growth, okay? These 7 companies, of course, are AI companies. NVIDIA, Microsoft, Google, Apple, okay? These are the companies, and then these companies are heavily invested in by the GCC nations. So if these nations are no longer able to invest in the stock market, these companies will collapse in value. And with that, that would lead to economic depression in America. Okay, does that make sense? All right, so that is the situation for today. Today was just an overview.
So, once again, to just do a quick overview there. The Gulf Coast countries sell their oil to the world, but they only accept US dollars. They take those US dollars and they park those US dollars in the form of a US company, such as Google, Microsoft, FANG, Magnificent Seven, or right in US treasuries. Okay, so there's both of those two things to consider when this entire thing is going down. It's like, well, if these countries aren't, first off, able to really get their oil out, if they're not making the money, right, then they can't take that money and put it into the US stock market. And so this is a big concern for the value of the dollar, really the value of the dollar as a reserve currency asset, and the entire concept of the petrodollar system is at stake right here, right now. And so, so for anyone also, if you weren't aware, we did an episode on Professor Zhang on memes and markets just, um, what was I saying? Just yesterday. And that was a really fun episode. We broke down a lot of his theories, kind of how he got to this point and whatnot. So if you haven't already gotten to memes and markets, you got to go over here and hit that subscribe button. We go live every Tuesday and Thursday, and every once in a while, we'll do a surprise episode like we did yesterday. And this is a really good episode. It's a lot of fun. We just kind of go through some of those videos and go more in depth on like who is Professor Zhang exactly and how did he get to rise to such prominence in such a short period of time. So definitely check out memes and markets as always. That is my absolute baby project, and I'm excited about that one. But now back to the scheduled programming here. One of the big things that has been happening in the United States is the U.S. is actually going ahead and starting to lift sanctions. So the big problem here is that Europe, right, has relied upon Russia for oil for quite some time. But once the Russia-Ukraine war started, the U.S. started to say, hey, wait a minute, you're not like, why would you keep buying your oil from Russia? They're going to take over Ukraine with all the money that you're funding them with, right? So you're all upset about what's happening in Ukraine, but you're funding them. You're buying all of their oil. And so the idea has been to get them to stop buying oil from Russia. And the United States is also like, we're sending so much resources and spending so much money to defend Europe and to help Europe. Yet you guys just keep buying the oil from Russia. So why are we helping you if you're buying all of Russia's oil? You're literally just funding your oppressor in this regard. And so with that said, what am I saying? So with that said, now that Russia, right, has been cut off, the U.S. has implemented sanctions on them as well, right? They said, look, if you buy oil from Russia, then we're just going to sanction you, right? We're going to stop allowing you to get access to our dollars and into our system. And so, but now what's happened is that, well, the whole world is short about 20% of its oil supply, and Russia tends to have cheap oil. And so the concern becomes, well, where are we all going to get our oil from? And Treasury Secretary Scott Bessent has said, well, because of what's happening here, we might have to actually lift some of these sanctions on Russian oil. And they're doing it in a very specific way. But let's go ahead and hear a little bit of Scott Bessent, the Treasury Secretary of the United States, talk about the situation.
The world is very well supplied in oil. Yesterday, Treasury agreed to let our allies in India start buying Russian oil that was already on the water. The Indians had been very good actors. We had asked them to stop buying sanctioned Russian oil this fall. They did. They were going to substitute it with U.S. oil. But to ease the temporary gap of oil around the world, we have given them permission to accept the Russian oil. We may unsanction other Russian oil. You know, the other thing Treasury can.
So that's an important thing that he just said there, because at first it was just, we'll let all of these oil tankers that are just stranded in the ocean, you can buy that Russian oil. But in this statement right here, he's actually pivoted and said, well, we might actually also allow you to buy other Russian oil too.
We may unsanction other Russian oil. You know, the other thing Treasury can do here, Larry, is there are hundreds of millions of barrels of sanctioned crude on the water, and in essence, by unsanctioning them, Treasury can create supply. And you know, we are looking at that. We're going to keep a cadence of announcing measures to bring relief to the market during this conflict. And Larry, I'm sure you agree with me that in our investment careers, the best investment you made was looking to the other side. And the other side here is that once this is over, then oil prices are going to be sustainably lower and in a safer position for years, if not decades to come. So I would encourage people to look to the other side of this.
So a lot of clapback from this statement. People are saying, oh, really? Yeah. So Josh Young, the same guy. Wow, he's pulling up on the feed today. I didn't really realize that. He said, what if we just tell everyone that the oil market is well supplied? I thought that was pretty good because obviously, right,
the world is very well supplied.
None of this would be in question if the world was so well supplied with oil. Then why are we lifting the sanctions on Russia all of a sudden? So anyways, this is kind of one of the major developments there, is that even Russia is going to potentially start to benefit from this. And that is going to be something to keep an eye on, let me tell you. So, in terms of like, what are the different things to be thinking about what to do about what's going on here? There are oil sensitive sectors that are going to be hit by this. And a lot of those are going to be things in transportation, logistics kind of world. You're talking about airlines, shipping, trucking, chemicals, and agriculture, which are going to face higher input costs as the price of oil continues to spike. We saw some headlines around like airline tickets are about to start going up way higher. So that's one of the things that's going to be hit by what's happening. Inflation is very likely to occur in this time. Scott Bessent, he just said it's not going to occur. Oil prices are going to come down really fast. That's what he just said. But once again, like that all depends on how long this war actually goes on, or how long the Strait of Hormuz in particular is going to be closed, and whether or not there's going to be some solution found to what that's going to look like. And if that is not found, if there is not a solution and the Strait of Hormuz stays stuck for anything more than just a week even, things are going to start to really heat up in the oil markets. And that's going to create inflation around the entire world. So there's also all this conversation around like, oh, well, it doesn't matter. We don't import our oil from the Gulf states. That doesn't matter. Oil trades at a global price. And the U.S. does import the oil that it actually uses from other places. It's a global phenomenon when it comes to the price of oil. Okay. So you can't just be like, oh, well, it doesn't matter because we don't import our oil from the Middle East. Like, brother, that's just simply not exactly how it works. Okay. So moving forward here, inflation hedges, right? There's even Treasury inflation protected securities. So treasuries that protect for inflation. You have commodities like gold, okay, which are often going to rise during energy shocks. Silver are other things that might continue to do well in these types of environments. Now, we talked about the equities that are downstream of oil, but then you got to think back to the origins of it, right? So the actual oil producers themselves are very likely to continue to benefit from higher oil prices. You've got Exxon, you've got Chevron, you've got Marathon, XLE being the major one that is just an ETF that's a basket of all of these types of companies. Very likely to continue to perform throughout this environment if we can see that this continues. Now, the big problem here, though, is that we're going to probably see a negative shock in the markets before any of that really continues to play out. We've seen very small signs of volatility in the markets continuing to rise. Okay. And the biggest thing that we were just talking about this week as well, we got the jobs report on Friday, is that the labor market is weakening. So the Federal Reserve here is about to run out of tools. Okay. The Fed can either lower rates or hike rates. And the whole thing that we've been waiting on is for lower interest rates. Lower interest rates and more stimulus to come into the markets because of some sort of a problem. Well, there is a big chance that the United States is going to have to create money to go out and fund this war if it continues and drags on the way that it is very likely to. And with that being the case, there's going to need to be some sort of a place where that money's coming from. The Big Beautiful Bill does account for an increase in defense spending. So there is legislation that has crossed the finish line that will allow for increased defense spending over the next year and a half or so. But when it comes to where we're at now, we talked a few months ago, I think it was a couple months ago, where Trump was talking about we need to increase the defense budget to 1.5 trillion, right? Like that might be closer to what needs to happen, okay, in order for all of this to actually work out. But my point was the labor market is getting worse and worse. Okay, when we look at the numbers in the labor market, they're continuing to weaken, and we're consistently getting revisions to the downside, right? So we keep on getting told that, oh, no, don't worry about the jobs market, everything's fine. But every single time we get a new jobs number, we're also getting revisions from the previous number saying that it was much lower than we had expected. Let me go ahead and zoom in a little bit so you guys can see. This is the general trend of the non-farm employment change. Just imagine jobs being added to the economy, right? We're seeing that this is back from 2021-ish, and you can see how that's just continued to fall and fall and fall and fall. Okay. And at this point, we're starting to get negative reads. We're starting to lose jobs in the economy. Okay. And we're getting revisions that the previous announcements that were made were wrong and that there were fewer jobs added in the previous announcements as well. So not only is this the trend, but apparently it's way worse than we're being told when the initial data comes out. So this is another big problem in the United States is the labor market is weakening at the same time that all of this is going on. And so if the Fed tries to, the problem here is that the economy is weakening. So the Fed could just lower rates, right? Okay, lower rates, try to spur more investment and be cool. But now we've got this oil problem happening where inflation might start to come in. So if they try to lower rates into an inflationary environment, you can very easily overheat the economy. Okay. And that's obviously not what you want to see. So I just wanted to point that out as well, as this is the other side of the conversation here is the job market activity. Now, with all of that said, I'll play a quick clip from Kathy Woods talking about the jobs situation as well. And then from there, we'll move into Q&A and break down anything else that anyone wants to chat about. So Kathy Woods is the manager of an ETF family called ARK. And ARK had its moment back a few years ago where they were kind of like, oh, we're coming out and leading the way in terms of innovation. This was during at the end of 2020, she kind of had her moment. And they had this huge run up. They were big owners of Tesla and other high tech stocks like that. And then they've had this massive fall. And this is just the ARK Innovation ETF in particular. And ever since then, they've had a massive fall in the price of that ETF. And it's continued to kind of do its thing since then. But Kathy Woods is the manager of this fund family, and she has incredible thoughts regardless of the fund performance itself. A lot of people, oh, I got to show a meme about that. That's actually hilarious. Oh man, hold on. I got to do this because this is so much fun. Real quick. So there's this concept going on right now because Chamath Palihapitiya came out and basically told his investors, they were like, look, you lost money. You should be happy that I gave you a capital loss that you can refund your taxes. And so Investing Visuals has come out and said they've made this concept of a graphic that says capital losses as a service. And let me tell you, y'all, that's pretty dang funny. I know this isn't memes and markets, but that is hilarious. Capital Loss as a Service, Part 2, Kathy Woods. But aside from that, she has incredible thoughts that she's going to share with us right here. And I highly recommend paying attention to some of the things that she talks about. The fund performance is a totally different conversation, but here we go.
Is under attack. Part of that access is under attack. In the U.S., are going along so the various bond markets are not, they've been a little volatile over the last week, but they haven't capitulated. You have a down day and an up day.
She's about to talk about the jobs market in just a second.
It's because this kind of news is leaking out, and I think it's very positive. So now, before we go into the charts, what I'd like to do is, it is Employment Friday, and to be honest, the government's employment statistics are becoming pretty useless. So it's kind of hilarious that we started doing this because of Employment Friday. Nonetheless, they affect the markets, and over time, I think that impact will diminish because these numbers are revised down or up, but mostly recently down. Now, what's so interesting is non-farm payroll employment dropped 92,000. It was supposed to be up 55,000 based on all of the other employment indicators out there, which are all pointing up. So the ISM index employment indicators for both the manufacturing and service sectors, initial claims are quiescent. And just ADP reports have come, now they're reporting weekly and they've been up every week. And so this Bureau of Labor Statistics report is beginning to look a little ridiculous. We mentioned during the last In the Know that last year, the non-farm payroll employment numbers were revised down for the year by 865,000. That took away employment gains for many months when we thought employment was stronger than expected. It took those numbers way down. Now, there is another statistic. It's called household employment that comes out on the same day. It's more reliable. It includes many more small businesses. And it, too, was down. It was down, I believe, at 185,000. Now, there was the Kaiser Permanente strike that impacted both. And there was very bad weather. So that's absolutely a consideration as well. But it does seem that employment is being revised down regularly, including last month. I think if I'm not mistaken, the downward revision was 69,000 for the last 2 months. So, it is getting to be kind of ridiculous. But the household employment number rarely is revised. They do, I think it's a 5-year revision, but they do revisions quite infrequently. And that number was revised down by 1.4 million jobs for last year. Now, it corroborates what we've been thinking. These downward revisions are partly a function of productivity growth being much higher than expected. And so what does it mean? GDP really is not being revised. So when you revise down employment, in order to get the same amount of GDP, productivity has to have increased.
So just a little bit of a take on what's happening with these jobs numbers, right? And what that all means and what that is all about. So yeah, people don't like Kathy. Kathy's a broken clock. Well, the reason I brought what she said up there is because it really has nothing to do with her. It has to do with the reality of the situation with the jobs market report and how it's losing credibility, even for someone who has already lost credibility herself, right? But yeah, so anyways, at this point, like I said, the Fed's in a pickle. They can't lower rates. If they lower rates, they could play into this inflation problem. Last year was because of the tariffs. Oh, we don't know what's going to happen with the tariffs. We can't lower rates. Okay, well, now you got an oil spike. You got a whole war in the Middle East. Now you can't lower rates. What are we going to do? We'll see in May when you get a new Fed chair in place. But it's going to be really hard to get people in alignment with the idea of lowering rates, especially if we have a war going on. So with all of that said, I mean, not too much has really changed on the thesis of what comes next here. The only other thing that I guess I haven't talked about yet was the whole XRP situation. So Jay Claver has his domino theory. It's this huge thing where the world is going to come to this place where it needs liquidity, and XRP will be the answer to that liquidity and how it's needed. I won't go in depth on that today. We talk about it in the channel members section. But as of right now, this XRP asset is continuing to fall with the rest of Bitcoin and everything else, right? All these cryptos are probably going to continue to fall throughout this war scenario. And in fact, throughout the bear market that we're in at this moment. And so, yeah, someone said, Danaman said, it's not the person, it's the knowledge that it transmits and share. Yeah, I'll always have that perspective of, we've got people that are super smart, that have made poor decisions and so on, and have lessons also to share with us as they learn. We're all people out here learning and making mistakes. It's definitely something that I've learned over the past 8 months of doing this YouTube channel. But so XRP is coming down and Bitcoin is coming down. The first thing that was in XRP domino theory from Jay Claver was oil spiking. And he's been talking about this for a couple of years, right? We've got at least that first piece is oil spiking. The next thing that he mentioned was that this would have to lead to Japan basically needing to hike rates because of inflation in their economy getting too high. Once Japan starts to hike rates, the reverse carry trade needs to unwind. And then once that happens, the entire system can kind of get to a place to where there needs to be some injection of liquidity. So with all that said, oil has spiked. That's the first piece of the domino theory down. With all of this in place, my major thing is, what am I doing personally, guys? The whole point was, what's the thesis now? Nothing has really changed. One thing that is changing is that the prices of risk assets, really just crypto at this point, are going down. Whereas the prices of things like gold and silver are continuing to go up. Now, when we really think about that, what could be the asymmetric opportunity in an environment like that? Well, it could be, right, to start to allocate towards the things that are going down. Now, this is all about you, and none of this is financial advice. I'm just a random guy on the internet talking to a wall. There is no right answer for everyone. But what there is asymmetric opportunities. And for me, right, just the other day, what am I doing? I'm continuing to DCA into the assets that I believe in the crypto space. And when I'm really feeling like there's a good discount, I'm going to buy. I'm going to take a little bit of extra cash. I'm going to buy. You know what I mean? That's just me. That's just what I'm doing. Not recommending anybody do anything. So you've got the 3 different time frames that we've talked about in the past. You've got the tactical time frame, couple weeks till a month at a time. You've got the cyclical time frame that might be all the way from 6 months to 2 years, 4 years. And then you've got the secular time frame of what's happening on the longer term, 10, 20 years, decades ahead, what's happening. I truly do think that what's happening with gold is a secular trend. I think we're at the beginning of a secular trend for what happens with gold here. The United States dollar is going to have a response to the fact that countries are going away from that. And I do believe that there will be some sort of incorporation of what's happening with digital assets into that. Whether that's the case or not doesn't really matter, because you also have a secular move in what's happening with cryptocurrency. Crypto has been around since 2009. Okay, we are a little bit less than 20 years into that phenomenon. And the price has only gone in that time in one direction, which is up. So when you get moments where you're in the middle of a secular move that is higher, right? And you get an opportunity where you have a cyclical, let's imagine we're in a bear market for crypto, that's lower, then those become the opportune times to allocate towards those things, right? As you go through that cyclical bear and back up into the cyclical bull. So I'm going to open the floor for questions as we talk about what is coming next here, what is on your guys' minds. Let me know. And with that, also, I will remind everyone that I just announced today a partnership with Caleb and Brown, which is something that I'm super excited about. They are by far the best crypto brokerage in terms of you pick up the phone, you talk to someone. Guys, you know how rare that is? You know how hard it is to get in touch with Coinbase, y'all? You can't pick up the phone and get on the phone with Coinbase. Okay. And that is why I'm just so excited about Caleb and Brown. And like I said, guys, I spent months talking to these guys because I was like, I don't know, let me make sure 100% that this is something I believe in. And I did that. And this is where we're at. And on top of that, you can literally also email my guy, Jim. If you just have any questions, you just want to say, hey, I've got some questions. I just want to set up a time or figure something out. Let me talk to you, Jim. And I put the email and the link to go ahead and sign up for Caleb and Brown in the description of this video. So while you guys' questions are coming in, just wanted to let you guys know that I have officially signed a partnership with Caleb and Brown. And I truly believe in what they offer. You've got personalized brokers. You got a fixed fee for your trades. All this. You've got all the good assets are there, right? You don't have to worry about that. Oh, and another big thing is they have no limits. So this is another really big thing, because when crypto does go up, if it goes up, not a fortune teller, one of the biggest problems that people run into is that when you have one exchange, and this is why I always tell you, you got to have multiple exchanges. You got to have multiple exchanges, multiple hardware wallets, multiple ways of storing your crypto. Okay. Because what happens is for instance, on Coinbase, you're going to have a limit of how much you can withdraw from there at a time. And so what you're going to have to do is once a day, withdraw the maximum amount from Coinbase that you can, or have multiple exchanges that you spread everything out across and use the maximum amount that you can withdraw from those exchanges every day. Or you can be super hyper prepared and have a certain amount of your crypto assets that are on Caleb and Brown where they have no limits for how much you can deposit and withdraw at any one time. And that's also the important of being able to pick up the phone and say, hey, yo, my guy, this is the move that we need to make. Hey, or hey, what is the move that I should make? Right? Depending upon your kind of style of how you'd like to develop that relationship with your broker over at Caleb and Brown. So anyways, just wanted to make sure that you guys were aware of this partnership. You can find a link in the description to sign up to Caleb and Brown. I will also have it as a pinned comment after this video. So let's go ahead and see what's going on in the chat, some of the questions that you guys are asking. Okay, so what do I think about altcoins? For example, Cardano and Solana. Well, I mean, all crypto is going to continue to go down at this particular moment. What do I think of them as actual investment opportunities? or as technologies, I guess rather is how I would reframe the other side of the question. Cardano has done an incredible job of building out a proper consensus mechanism. Now, if you guys know me, I'm not the person to really choose a particular blockchain, right? When it comes to blockchains, they're all going to be, in a sense, they're kind of commoditized. Now, it's a weird thing to say because every single blockchain is different. It's so unique. But the service that they're offering of being able to use it to get transactions across the line kind of gets commoditized when you can send value across the internet without a centralized counterparty. But now, when it comes to the major thing that's not commoditized is the scalability and the security of the blockchain. So Bitcoin is supposed to be the most secure blockchain, right? It is. It's the most secure network in the world, right? And that's something that you can't trade for something else. And when you're thinking about something like Cardano, that's one of the things that they've done differently than Bitcoin, but they've also taken a really long time to get right in terms of how to get a secure platform that is not a proof of work platform that is overly energy intensive. So when I think about like the massive blockchains that are built to operate at scale, I do think that what Cardano has done with their consensus mechanism is really, really interesting. Now, when you compare that to something like Solana, which is all about speed and scalability, but without the security or the uptime, right? I really look at Solana. I'm gonna be honest with you guys. I look at Solana as it's like a toy. Like it's like a McLaren. I don't know if you guys are car people, but McLarens are notorious for breaking down as soon as you pull it off the lot, right? So it's fast and it'll win a race, but it's also going to break down really fast. And that's kind of exactly how I look at Solana. It's not really, I don't even take it seriously. Not to say that I don't take McLaren seriously. McLaren, if you ever want to sponsor the stream, let me know. I'll wear a cap. But, just saying. That's kind of how I look at Solana. I almost look at it as just like a really well done marketing campaign for a chain that doesn't even, that constantly goes down. But that's just my own personal take. I also have very rarely used it. And the times that I have tried to use it was always when there was like some hype going on and it wasn't working very well. Just being honest. All right, let's see here. Thank you, What a Sales, and congratulations on the collaboration. Yeah, I'm super excited about it. Thank you. What do I think about paper versus physical silver? Yeah, I mean, guys, it's the same equation. It's always the same thing. It's diversify your holdings, right? And the way that I was talking to someone about this the other day is like, when you buy these precious metals, when you buy a physical precious metal, there's a different kind of mentality that you should have around it, right? Because I'm buying physical gold, physical silver, and I'm putting it in a safe or whatever. That gold, that silver is not really there to be sold at any point in time, right? That gold and silver is tucked away and is a part of my wealth. Kind of like how people buy a home and they sit in their house. You just sit in the house. Now, obviously, you can sell your house. A lot of people sell their house. But it's not meant to be a vehicle of, like, you're not going out to the market every day or to the grocery store and like spending equity in your house, right? And I think that's kind of a different way of looking at your physical gold and silver as well. And then on the other hand, your paper silver is like if you went out and you bought shares of a real estate ETF. It's the same thing. Where actually, yeah, I'm not sitting on those real estate ETFs like it's my house or an apartment building that I bought. Instead, it's sitting there like an ETF that I can buy and sell and get out of as I need to. So I think you diversify your holdings across different offerings, across different exposure to the asset. In another way, it's right, cash flows off of the asset, right? So to make that comparison again, buying a home to sit in is not really an investment. Okay, I want to be clear. That's not really an investment if you're going to live in your home. Okay, it's a place to park money, but it's not a cash flowing investment. and it becomes a liability when you have to repair anything that breaks down. Conversation for another day. To all my older folks in here, don't get mad at me. When it comes to looking at the difference between that and buying a real estate ETF, which cash flows and pays dividends, right? That's the difference between also having, let's say, physical gold and silver, or owning a miner, right? That cash flows and pays dividends off of also getting the appreciation that comes with the price of oil going up and down. Excuse me. My goodness. Gold going up or down. So the point that I'm trying to make is that there's different ways to think about diversification in this realm. It's obviously physical versus paper. It's different types of paper. It's also stock and equity and cash flows that you can get from the same asset or underlying commodity that you're trying to get exposure to, right? So hopefully that made some sense there. Let me see the chat. Let me see the chat. Brothers and sisters. Yeah, so someone asked, what are the fees? What is the cost of Caleb & Brown? So to set up an account is totally free. Set up an account is totally free. The fees, I believe, is 3.5% flat fee on every transaction. I think that's what it is. Let me make sure. Yeah. So the cool thing about that is that it's upfront, and that's what they do, right? They don't have all these hidden fees. They don't charge you spreads like a lot of exchanges will do. And so when activity hypes up, the spreads get wider. So you end up paying more, and that is undefined because spreads can go in unlimited in any direction. But Caleb & Brown doesn't do that, from what I understand. It's just a flat fee every time. And it's not a super low fee, right? But you also get all the extra services, being talked to someone and all of this stuff. And also, once again, you can work with them as a place to have a place to go when you want to make transactions, to make sure that you have an account, that you're verified, that you're KYC. That's another thing, guys. Oh my goodness. When you sign up for these exchanges, always KYC. Always KYC immediately. Because what happens is people send money to exchanges and then you can't take it off until you KYC. So always KYC when you get on an exchange. Keith, what are your thoughts on programmable money? How does Iran impact it? And will Cuba be next because of the oil to the Gulf ports in Louisiana? So there's a lot of talk about Cuba being next, period. I haven't done the research just yet on why that is. But the idea that it has something to do with oil is fascinating, right? Because, yes, it's been very clear that Trump is going to do something with Cuba. Sin duda, without a doubt. So, and what's happened over there right now, by the way, is they've had these protests in the streets because of the their electricity has been out for some massive amount of time. So now there's people in the streets protesting in Cuba, which is just unideal. And so that situation is going down. Right. Let's see. What else do we got from you guys? Do I think the price of crude oil will incentivize EV production? I think the geopolitics of what's happening with oil will incentivize EV production, right? Because no one wants to be reliant on one another. I think that alone is more of the equation here. Is just the war, right? Says, all right, well, I need to find a way to not be so reliant on oil, even in the UAE alone, for instance, right? The UAE is saying, hey, we need to start working on EVs because we don't want to have all of our income and revenues based upon oil all of the time. So that is something that is happening. The world is moving towards EVs as far as building the capability to be able to have electric vehicles and renewable sources that they can use so that they also just don't have to rely on one another. It's kind of like a part of the de-dollarization trend in some ways, right? The de-oil trade, de-dollarization as well. Let's see. Cardi Eden said, "Thank you, Keith. I appreciate you." I appreciate you. Thank you guys for being here and for spending some time hanging out. It's always fun, fun, fun. Thoughts on impacts Japan economy will see in the medium term due to the oil chaos. Yeah. So the big thing is that Japan is heavily reliant up on um, the Strait for its oil. I think it was like 80% of its oil is coming from the Strait of Hormuz. So Japan will very briefly be impacted drastically by what's happening there. From what I did understand, I think they have a nice amount of oil reserves, to be fair. So it won't be immediate, but it also won't take long for the impact to be drastic. And this is something that is, I think, a concern for the entire region of East Asia in general. Let's see. Uh, Canig Attack Knigeta channel. I have diversified so much that I have my own garden and livestock. I love that. I love that so much. That is so cool. Does Bitcoin get a step up in basis? Are you saying does it get a step up in basis for tax purposes? Any asset, right? Any asset is going to have the same treatment in that regard. Any asset that you have a capital gain or a loss on. I'm not a tax professional. It's not tax advice. Let's see. Could a physically backed gold or silver ETC decouple from the spot price, even though it is backed by allocated metal and investors can claim their share stored in the vault? Absolutely, Johan. Could a physically backed gold or silver, I'm assuming you mean exchange traded fund or exchange traded product. I haven't seen ETC before. I don't know what the C would be. ETP or an ETF. Decouple from the spot price. Could a physically backed gold or silver ETF decouple from the spot price? It's very possible. I mean, this is kind of what some of the hoopla around the dislocation of or the premium that people are paying in certain exchanges and in certain markets for physical silver and gold is all about, right? That kind of is what that is. It's not that the price of the ETFs is like lower than or like going down, but you'll see instead an increase in the price of the spot for the physical metal, right? So you'll see the spread between the physical metal and the spot prices of the ETFs widen. And that in a sense is the same thing as there being that decoupling. Hopefully that made some sense. Where do I leave my keys? That's hilarious. I leave my keys on the key hanger. All right. Do you have to pay capital gains on crypto? Hey, now said, yes, you do. You do. Absolutely. Not tax advice. I'm not a tax advisor. What is KYC? Oh, wow. Yeah. KYC is know your customer, which means like when you go onto these exchanges, you have to upload your ID and do that whole process or whatever so that they know who you are and then they can allow you to transact. So it's by the law that these exchanges have to get that information. Otherwise, they can't allow you to like send money to their exchange and then get it off. And so that's why I say when you sign up for Caleb and Brown or any other exchange, always do the KYC. It's the first, every time I get on exchange, I haven't completed the sign up process until I have done that, right? Because otherwise what'll happen is you'll forget, right? So you'll have signed up for an exchange, but you'll forget that you didn't KYC. And if you didn't KYC and then you send something to it, then you're like, oh, snap, I got to KYC just to get anything off of it. And when the markets start getting crazy and like there was a time where Coinbase wasn't able to KYC people for like weeks. And like, think about that. You send your crypto to an exchange and you need to sell it or you're ready to sell it or whatever. And you can't because you have to KYC first. Or you want to pull the assets off even. Let's just say you sold it already, but you need to pull the assets off because sometimes you can sell but not pull the assets off. You got to wait weeks, right? Because they're backed up or whatever, which is what happened in Coinbase. I think it was like 2018 or 2017 that happened. Then it's like, oh, anything can happen throughout that time on your account. Anything can happen in the markets, whatever. So I always immediately, as soon as I sign up for a crypto exchange, I KYC because one, you'll just forget. And two, there might be times where you want to do it and you just can't because there's a backup and all this kind of stuff. So, yeah, thanks for that question. We say KYC and stuff like that's everyone knows what that is, but not everyone has heard that or knows what that means. Why aren't we just using Venezuela oil or our own oil? Well, for now we are. But I guess the question is, why do we continue to go out into the world and get more or fight these kinds of wars? Yeah, I mean, it comes down to it's not just about having the oil; it's also having command and control of the trade of it, right? We're starting to see, right, how China is highly reliant upon the Strait of Hormuz, right? So we're creating a choke point on China's oil. We're seeing Japan gets a lot of its oil from there. Huge choke point for Japan's oil. We've put a lot of sanctions on Russia, right, for their oil sales. And so it's really not just the oil itself, it's also the power, right, that comes with our people trading oil also in US dollars or not, right? Because this is what a lot of people are speculating is that Iran, right, not selling their oil in US dollars, using other methods to do it is a part of why this whole thing started to break out. What ways can you profit from the war in terms of investments, calls, puts, etc.? Well, I'm not a financial advisor. This is not financial advice, but oil is going to provide some interesting situations here when it comes to like things like in the options market. What I would say, there's a few things in the options markets that people aren't necessarily aware of. Everyone thinks to buy options. You don't have to buy options to make money in the options market. You can also sell options. Okay. And in this situation, I think something that might happen is something that might be an idea is to go long volatility. There's ways to use options to not just also bet on price going up or down, but also to bet on prices either staying within a certain range of price or going outside of that range of price. Now, that's an entire lesson for another day. You have several different ways that you can set up those types of strategies. But if you look up how to go long volatility in an asset like oil, that might be something that could be a way to think about opportunities in the market, going long volatility on oil. Do you think that oil will stay in a tight band in price, or do you think it'll go in a wider range? I think that's something that we can kind of bet on. For me personally, rather. Let's see, folks. Do I think AI will replace macro or event traders soon? That's coming from Abercrombie K. Abercrombie Kid 1000. Do you think AI will replace macro event traders soon? No, I don't personally, but maybe I'm super biased. I don't think so. I think that there's a lot of emotional aspects of this that are constantly playing out in the markets, and I think because of that, um, there'll probably always be room for discretionary and even just people who are trading these events. 960 Liz said, if you ever show Josh Young again, especially as an expert, I'll unsubscribe. Mr. Global has all your answers. Who's Mr. Global? And what did Josh Young do that was so wrong? I'm actually curious. I have no idea. Mr. Global, thank you for putting me onto that. I haven't seen him before. I'll go ahead and check him out. He's clearly an oil guy, or at least he's talking about what's going on right now. So check him out. Okay. Tone Steak said bye, 960 Liz. Yeah, I'm curious as to what he did. Are we even using Venezuelan oil while Iran is restricting oil exports through Hormuz? I think that's actually a really good question. That's one I don't have the answer to, right? Like, we've apparently taken command of the Venezuelan oil, but like, what is actually going on there, right? Because I haven't seen any updates about that. What is Sel said? What do you think of MSTR and strategy? MSTR and strategy. Yeah. You know, I've never been a huge fan of a leveraged play on Bitcoin, right? I think Bitcoin is leveraged enough, my friends. I really don't think you need a leveraged equity on Bitcoin. And the reason I add that word leveraged equity, right, is because it's already so far disconnected from Bitcoin. It's already really a bunch of debt that you're buying. And then you're buying an equity. So as the company goes bankrupt, you lose everything. And it's like, well, that's kind of silly when the whole point of Bitcoin is that you don't want to have to deal with um, that kind of a risk. There's no counterparty, right? That's the whole point of Bitcoin. Now, listen, there's different ways to use your portfolio. Bitcoin has its own place in the portfolio. And obviously, you don't replace your Bitcoin with MSTR, right? That's not what I guess is being asked of anyone to buy MicroStrategy, but that's my take. Like I've never touched it with a 10-foot pole. I just thought that it was kind of silly. I don't get it. But I mean, I'm also just not, like that financial wizard. A lot of people who are financial wizards, who are engineers, like smart people, they buy it. I think it's just fundamentally a dumb offering. Why would I give you my money to go out and buy Bitcoin for me with a bunch of debt? Why wouldn't I just buy Bitcoin? And if I want a leveraged bet on Bitcoin, then I would buy a leveraged Bitcoin ETF, not MicroStrategy. But I don't know. Maybe there's definitely something about this that I overlook, right? Maybe it's not that simple. More monkey business 589. Yeah, he definitely did do that. I'm dead. Bob Franklin 5335 said a friend of mine had to wait over a month for Coinbase to let him move his funds. Yeah. Yeah, it sucks because you also can't really get in touch with them very easily. And that sucks. Like when I'm dealing with assets that like can't be like gotten back, like if you do something wrong and all that, like I would like to be able to talk to someone. And I just think that it's and none of them do that. You know what I mean? No, none of these exchanges do that. Caleb and Brown is a full-on brokerage where you can actually talk to someone. I think that's super cool. Menesis said, does Caleb and Brown custody our coins? Yes, they are a custodial exchange and they work with Fireblocks to basically manage the custody process, right? So it is a custodial exchange, fully custodial exchange, and they have institutional grade cold storage with Fireblocks, which is the industry sort of leading custody providers. And that's another big thing about them is that they're all about security, right? Because of the fact that you've got someone that you can talk to and all of this, there's tons of different security and protocols that they have in place to make sure that you're always safe with them. Let's see. And what is the benefits from using Caleb and Brown? So a lot of the things that I've already talked about, I won't keep talking about it too much, but you've got someone that you can talk to. So that depends on who you are. You might not need that. You might not want that, right? I know a lot of my people that are watching this are either kind of newer to the game or also just would like to have that kind of experience. I mean, how cool is it to have someone to actually talk about your money with without having to pay some crazy amount of money to have some financial advisor or whatever? And how many of those people who are financial advisors and whatnot, what do they know about crypto, right? So these are people that are deep in the game. They help people with cold storage. They help people with like all these different things. Like, imagine you have an actual expert that you can talk to who might know more than me, right? About what you are doing with your assets and whatnot. So that's one of the major things that I think is what makes them unique. But then on top of that, it's also the fee structure, right? So instead of having to worry about spreads widening on you, you've got a fixed amount that you're going to pay whenever. And you also have no withdrawal limits. Those are some of the biggest things. And in this day and age, everyone's always asking me about, what do you think about this exchange? What do you think about this exchange? And I'm like, the first thing I want to know is how long have they been around? And have they been around through all the different bear markets that we've seen? And Caleb and Brown's been around since 2016, and they've continued to be helpful throughout all of that time. So those are the main things I would say is really having that white glove experience. Why is there such a terrible narrative about renewable energy in the United States? I think, well, I don't know. I mean, I guess part of it is like, where is the money being made? Oil and gas. Yeah, I think that's a big part of it. Johan Johan, we can answer those types of questions inside the channel memberships. I don't mind that. We'll talk about that a little bit more in there. Um, does USA have strategic oil reserves? Yeah, we went over that a little bit earlier in the episode, or in this live stream rather. We talked about the Strategic Petroleum Reserve that came out after the 1973 oil embargo in 1975. Yeah, we do, but it's not that much, right? It's enough for 35 days. Essentially, is what we came to the conclusion of. How do I feel about the Algorand blockchain? I think we've talked about it once before. I'm not a huge fan of individual blockchains. In general, I'm usually not a huge fan of that. There was something else that we talked about with Algorand, I think last week or maybe 2 weeks ago, that was unique to me. It was news to me. They have cool partnerships. I remember one of the guys in the chat talked about that with like the United States military and whatnot. I think there was something else about them that I missed that was like important as well. Okay. Minesis 3113 again. What is the difference between Caleb and Brown and an exchange like Robinhood? Main difference is that we're talking crypto focused for one. Robinhood's everywhere. They do everything, which is fine. I personally don't use Robinhood. I don't trust Robinhood. And they lost not even just my trust, but just the credibility with the move that they made back with the GameStop scenario. Personally, that's just my personal thing. I don't have anything against them. And for Caleb and Brown, you can talk to someone. Once again, guys, none of these like larger exchanges and brokers, they really don't often allow you to talk to them like that. But that's the whole service, right, that Caleb and Brown is offering. I'm not sure that you can't talk to Robinhood. I'm sure you can. They're an actual SEC registered broker, so I'm sure you can. But it's just very different. And what do they know about crypto, right? Probably very little. Let's see. All right, folks. Mhm. Mm, maybe I'm like way behind. Yeah, I am behind. Okay, cool. No, I caught up. All right, guys. How do I think the emerging markets will play out? Yeah, I think the emerging markets, well, we've seen them perform relatively well throughout just the past year, where we've had this like end of American sort of dominance trade, or whatever it's called. End of American exceptionalism was the terms that were being used. We've seen the emerging markets continue to perform, even like I think Venezuela's stock market like soared once they took the president out of the country. But a lot of that also has to do with the decline of the dollar, and we have to look at that relative, right? Like, uh, is the gains that we're seeing in these emerging markets economies actually outpacing uh, the inflation of their currencies that they're facing and things like that? Um, which in some cases they are. I have a lot of troubles. The problem is this: America has all the tech. Like, there's no competing with Google, Microsoft, Apple, Amazon. You know what I'm saying? Like, you can't compete with that. So in that regard, a lot of the money and the investment capital that's going to flow throughout the West is not going to stop coming to the U.S. That's one thing that the U.S. can kind of use as a huge kind of thing that it has against every country. You can't compete with that part. That's already been done. The groundwork for that's been laid over the past 20, 30 years. So when it comes to trying to make an equity investment or a risk investment, that's very different than the treasury situation, right? I might not want to hold your treasuries, but I might kind of have to, because I want to have access to US dollars and I need those dollars to go out and buy your companies. So in that regard, I don't know that the other countries will be able to meaningfully outperform American markets over the next decade and a half or two, three, four, five. I don't think that ever it'll be very easy to outperform the American equities markets. So I don't know. This is my personal take on that. But anyways, guys, let me see. If you haven't already, you gotta subscribe to the live show that I do with Ben Levitt. We're continuing to have so much fun, and in fact, getting cooler and cooler guests on. You might have missed, we had Charles Hoskinson on a couple weeks ago, or a week and a half ago. We just had Leonard Ulrich on, who apparently you guys know pretty well, or at least a lot of his guys also know me, which is super, super cool. And then we had Django on the other day, and he's a lot of fun. He does a lot of talk and commentary around what's going on in the culture, and just a super cool guy. So that was a lot of fun. And then we just recently did an episode on who is Professor Jang. We didn't have him on just yet, but we will in the future. So definitely go and subscribe to Memes and Markets. You can find the link in the description of this video to go ahead and subscribe to Memes and Markets. And as I mentioned a couple times throughout the stream, I just started a new partnership with Caleb and Brown. So these guys are the premier crypto brokerage. I saw someone ask, what if I'm out in the US? Well, even if you're outside the US, I believe you can still access Caleb and Brown. So definitely sign up. They are in the US and Australia, at least, and in some other countries as well. So check them out. You can click the link in the description to sign up. It's totally free. Open up a free account, do your KYC, upload your ID, identify yourself with them so that you can use the full service. And you'll very quickly be reached out by a broker. And then after that, also, you can always reach out to them whenever you have questions, whenever you have stuff that you want to talk about. So Keith D and Caleb Brown connecting there. And like I said, Jim Bazzani is my contact there. He's been super helpful throughout this entire process. Like I said, he's been talking to me for months, making sure that I felt super comfortable with the way that we were going to go about this. So you can check out his email in the link in the description as well. So if you just want to talk to him, say, hey, like, I'm curious about this. Like, what can you tell me about the rates? How does this all work? What do I need to do? This and that. And like have someone to really talk to and walk you through the process. Just shoot Jim an email and just say, hey, Keith sent me. Wanted to get some information about Caleb and Brown. So that email is also in the description of this video. It's jim.bazzani, Bazzani, at calebandbrown.com. Fantastic, everybody. Yep, I appreciate you all. And I'm excited for this week ahead. And if you haven't already, you got to make sure to hit that like button and subscribe. Make today the best day of your life, folks. Until next time. Peace. I was trying to put my face on it. Until next time. No, I'm not gonna end this until I get this right. Hold on. How do I change it? Peace.